Okay, so this week, just a second.
Uncle, can we just watch Warren Buffett's Secret Millionaire Club for the next whole class?
Yeah, there are many sessions. I don't know if you, yeah, that was also what I was thinking this morning. Why shouldn't we watch this? Yes, definitely. I think it's. I think they have about 30 plus episodes. So, but we should watch at least few of them so that you get idea of um, how he is teaching some lessons. Yeah, I agree. We should do that.
Okay.
So this week, yeah, Age of Easy Money is a documentary released on 14th of March in US in PBS. Mm, I would definitely recommend to watch this documentary. It's free if you are in US or Canada. Um, Only way to access it is via VPN. You can get the free VPN and then you can access it. I watched it. It's really interesting. In the nutshell, this documentary describes what central banks has done last 10, 12 years, due to last financial crisis in 2008, 2009. They reduced the interest rates to very low. That created this inflation, other issues, and now they are trying to increase the interest rates. How it's panning out is very interesting story. It's a reality, but you would also get the understanding of what central banks can do to economies or individual financial situations. So I recommend you to watch it slowly, and watch it one or two times. I think some of the terms may be difficult. Try to watch with your parents. Maybe they can able to explain few of the terms. But it was in plain English. It was not that difficult to understand. Anybody can follow this documentary. Okay, so yeah, so we reached to the point now. We looked at the financial statements to understand the healthiness of the business. Now it's time to calculate the value of the business. It's called intrinsic value. This is the term you would be hearing quite often from now onwards for a next couple of sessions. Uh, The intrinsic value of the business is measuring the real value, how much value you want to pay for a business, based on the free cash flow. We talked about the free cash flow. Free cash flow is nothing but the mm, cash flow from operational activity of the business subtracted by capex. So anything, the capital expenditure that the business required to maintain the machinery, trucks, whatever, based on the business. Then whatever is left out is the free cash flow. Free cash flow, if you remember, I told that is the money. It comes to the investors if we are the shareholder of the business or if we are the owner of the business. So intrinsic value is basically is a it's a method or calculation of how much value we can extrapolate from the business. When I say extrapolate means how much value the business able to generate for next future years, and discounting that cash back to the present value will give us the intrinsic value. This is in nutshell is the intrinsic value. So basically what we are trying to if I given you a business and then I told you, hey, this is the business I want you to invest, and I gave you the financial statements of the business, then by looking at the financial statements, you would try to calculate the free cash flow. You remember the free cash flow can be calculated from the cash flow statements. So you look at the cash generated from the operations and subtract that with capex, then you get the free cash flow. Then you take the free cash flow number and you project that free cash flow number for future 5-10 years and discount that future cash flow to the present value. That's how you would calculate the intrinsic value of the business. And um, then if you see this graph, so if you see time and value, and then there is a difference between intrinsic value and the price of the business. You know, price is something defined by the market. When the people are in happy mode, they try to pay more price to a business. Hence, the price of the business would be high. So if you see here in this graph, this line is the intrinsic value, the real value of the business, but the prices fluctuates based on the market mode, the blue line. So when the blue line is up, it's way above the intrinsic value. You see the difference here, the way above the intrinsic value. Then we call it overvalued or overpriced. So sometimes markets get heated up because last 10 years, right? Because of the low interest environment, even in the housing market in Denmark, right? You could also see that house prices almost doubled in last 5-6 years in many areas. Um, the real value versus the current price, then we call it overvalued. And at same time, the prices goes down so low that it is below the intrinsic value. It happened during the March 2020. Price of many businesses went down so low that they are below the intrinsic value. That time we call it is it's undervalue. Okay, so in nutshell, if you're able to calculate the intrinsic value, mm, keep the intrinsic value numbers and always look at the current price. And whenever you see it's overvalue, you just say that pass on. I don't want to play this ball. When there is undervalue, when the markets are um, pessimistic and they are penalizing the price of the business, then it's undervalued. Then you go and buy it based on your intrinsic value. So let's watch a video here from. Then you will understand this bit more in detail. But let's.
What is the intrinsic value of a stock? What is the intrinsic value of a stock?
The true worth of a stock.
But why is there a difference between the intrinsic value and the current price?
That's because the price of a stock is influenced by demand, supply, and most importantly, market sentiment.
People's expectations and speculations about a company drive the price of its stock away from its intrinsic value.
When this happens, the stock becomes overvalued or undervalued.
However, in the long run, a stock's price tries to move closer to its intrinsic value.
A good strategy is to buy when the stock price is lower than the intrinsic value. That way, when the stock price finally rises to the intrinsic value, you make a profit.
So that's it.
Okay, here we go. In this video, I'm going to take the time to explain exactly how Warren Buffett calculates the intrinsic value of a stock. We'll hear him explain it, and then we'll run through a full example in the second half of the video so you can follow along as well. But before we jump into the clips, I wanted to start at a high level. So when it comes to valuation, What are we trying to do? Well, we're trying to look at a business as a machine that prints money each year. We have to figure out how much to pay for the money printing machine now so that we get a good return on investment as it prints money out into the future. So following that analogy, we look at the business in its entirety, and then we figure out how much we'd pay to own the whole thing, considering it makes X amount of cash each year. Once we figure out how much we'd be willing to pay for the business, we can then compare that intrinsic value to the current market capitalization of the business. And the market cap, for those that don't know, is the total stock market value of a company. So it's equal to the amount of shares the business is divided up into, multiplied by the current share price. And if the market capitalization ends up being higher than our intrinsic value, then the business is overvalued. And if the market cap is lower than our intrinsic value, well, that's a good sign for us because it means that the business is undervalued. So that's what we're trying to do. And now I wanted to play this clip of Warren Buffett explaining exactly this process. Now,
But you understand, right? You can imagine business as a printing mission, a money printing mission. So basically, businesses are generating free cash flows every year, and you can simply compare that with a mission, money printing mission that prints the money. That's a free cash flow that's been generated out of business. And then basically, if you want to buy that mission, money printing mission, you need a method how much value you want to pay. So basically, in order to buy that mission, you want to understand how much money the mission can print. In this case, how much money the business can generate. Otherwise, how much money, how much free cash flow that a business can generate every year, and discounting that money back to the present value. So you are basically discounting, bring that value back to the present value to determine how much money you want to pay for the mission that printer prints the money. So that's a simple analogy to think through. How do you, look at the business?
warning, this is a long clip. It's 3 minutes long, but really listen to it. And also don't worry if you don't understand it immediately. We'll come back after and we'll run through a full example of the method he's about to explain. Over to you, Warren.
Is how do you find intrinsic value in a company?
Well, intrinsic value is what is the number that if you were all knowing about the future and could predict all the cash that a business would give you between now and Judgment Day, discounted at the proper discount rate, that number is what the intrinsic value of a business is. In other words, the only reason for making an investment and laying out money now is to get more money later on, right? That's what investing is all about. Now, when you look at a stock, when you look at a bond, assuming it's the United States government bond, it's very easy to tell how much you're going to get back. It says it right on the bond. It says when you get the interest payments. It says when you get the principal. So it's very easy to figure out the value of a bond. It can change tomorrow if interest rates change. But the cash flows are printed on the bond. The cash flows aren't printed on a stock certificate. That's the job of the analyst, is to print out, change that stock certificate, which represents an interest in the business, and change that into a bond and say, this is what I think is going to pay out in the future. When we buy, some new machine for Shaw to make carpet, that's what we're thinking about, obviously, and you all learn that in business school. But it's the same thing for a big business. If you buy Coca-Cola today, the company is selling for about $110 to $15 billion in the market. The question is, if you had 110 or 15 billion, you wouldn't be listening to me, but I'd be listening to you incidentally. But the question is, would you lay it out today to get what the Coca-Cola company is going to deliver to you over the next 200 or 300 years? The discount rate doesn't make much difference after as you get further out. And that is a question of how much cash they're going to give you. It isn't a question of, it isn't a question of how many analysts are going to recommend it or what the volume in the stock is or what the chart looks like or anything. It's a question of how much cash it's going to give you. That's the only reason. It's true if you're buying a farm. It's true if you're buying an apartment house. any financial asset, oil in the ground, you're laying out cash now to get more cash back later on. And the question is how much are you going to get, when are you going to get it, and how sure are you? And when I calculate intrinsic value of a business, when we buy businesses, and whether we're buying all of a business or a little piece of a business, I always think we're buying the whole business because that's my approach to it. I look at it and say, what will come out of this business and when? And what you really like, of course, is them to be able to use the money they earn and earn higher returns on it as you go along. I mean, Berkshire has never distributed anything to its shareholders, but its ability to distribute goes up as the value of the businesses we own increases. We can compound it internally, but the real question is, Berkshire selling for, we'll say, 105 or so billion now. What can we distribute from that 100? If you're going to buy the whole company for 105 billion now, can we distribute enough cash to you soon enough to make it sensible at present interest rates to lay out that cash now? And that's what it gets down to. And if you can't answer that question, you can't buy the stock.
So if your company was selling for a market cap of
So that's very important point that we all need to understand. If you want to invest in business, you need to know how to value the business. That's intrinsic value, and that's what all the great investors do, and the successful investors do. They always try to analyze the intrinsic value of the business, and then based on the intrinsic value, they look at the current market price. If the market price is below the intrinsic value, then they go and buy it. And if the market price is above the intrinsic value, then they just pass on because it's overvalued. Uh, that's how it's been calculated. Any questions? Anything you want to ask? No. Let's continue.
105 billion, can that business deliver enough cash to you soon enough to make it a sensible investment? That's what it boils down to. And the process we're going to go through to figure that out is called the discounted cash flow analysis. The long way of saying it, as Warren Buffett does, is the discounted present value of all future cash flows. Now that will make more sense in a minute, trust me. So with that said, let's begin. Here's what we're going to do. We're going to figure out what to buy the business for right now. Then we're going to hold the business for 10 years, and then we're going to sell it. So we'll have to outlay some cash right now to buy it. Then we'll receive 10 years of juicy profit from the business's operations. And then we'll get a big one-time check when we sell this thing in 10 years' time. So what do we pay for it now? That is the question. So first step is to find the amount of cash this money printing machine makes for its owner every year. That is the free cash flow. So the business makes money and spends money, and the free cash flow is what the business owners could potentially keep each year. And this number is calculated from two numbers on the cash flow statement. It is the cash flow from operations, or sometimes just the operating cash flow, minus the capital expenditure, alternatively known as the purchase of property, plant, and equipment. Now, if you wanted to get more precise, we would prefer to eliminate the part of the capital expenditure that's related to growth and expansion. So it would really be the cash flow from operations minus the capital expenditure needed just for maintenance. But unfortunately, this is very rarely reported by companies, and you kind of just have to figure it out yourself. So we'll just use free cash flow for this example. And don't worry, because using free cash flow is more conservative anyway. More conservative, but obviously slightly less accurate. So step one complete, we have the business's free cash flow. Then the next step is to figure out how well they're going to be able to grow their cash flow each year for the next 10 years. Now, this growth rate is down to you and your research, and it will be different for every single company. And quick word of warning here, the growth rate you use will have a big impact on the result of your intrinsic value calculations. So please don't go off into la-la land while you predict how much this business will grow in the next 10 years. Don't convince yourself they're going to grow at 200% annually for 10 years straight. I mean, even 25% growth per year is a very high growth rate to use. So Overall, a few ways to stay grounded. Number one, look at the prior 10 years of free cash flow growth and equity growth. You know, how quickly have they grown on average in the past? Then two, what is the typical growth rate of the industry? You know, what are other companies managing to achieve in the same industry? And then three, actually understand the future growth drivers for your business and how they will likely impact the cash flows. For example, Tesla right now has 2 new factories that will be coming online across the next 5 years, in fact, across the next year. And they'll be ramping up. So how will those factories impact the amount of vehicle deliveries? And what will that mean for Tesla's free cash flow, considering their current margins? So overall, there's a bit to think about, but these 3 pointers should help you come to a solid idea of an annual growth rate for your business. Let's just run for this example with 10% per year as a growth rate. So let's now grow the free cash flow out by 10% per year for the next 10 years. It's pretty easy, just multiply the previous year's free cash flow by 1.1. And then after that, now we're going to sell this thing. Now, of course, you don't actually have to sell it in real life, but for the calculation, we imagine we're going to sell the business in 10 years. This is called our terminal value. So what can we sell it for? Well, let's look at what multiple of free cash flow the business has been selling for over the past 5 years. If we take the average and let's say we could probably sell the business for that free cash flow multiple in, say, 10 years time. Now, honestly, 25.5 is probably quite a high multiple for this business that I'm modeling the numbers off. So of course you have to use your own judgment a little bit as well, but let's just run with 25.5 for the sake of this example. So now what we need to do is multiply the 10th year of free cash flow by our free cash flow multiple to get our terminal value. And there you have it. We have all of our future cash flows. But remember, this process is finding the sum of all the discounted future cash flows. So what's that all about? Well, remember Buffett said, can the business deliver the cash to you soon enough to justify buying the business at its current price? This time factor is very important. Remember, $1 today is worth more than $1 in 5 years because we don't have to wait 5 years to get it. If we get that dollar now, we could maybe invest it and turn it into, who knows, $2 or $3 by that 5-year mark. So you have to think about the opportunity costs. So what do? Well, say we want to achieve 15% annual returns in our stock portfolio. All we have to do is discount the future cash flows by 15% per year. And watch this, as you go further out in time, even though the company is growing its cash flows at 10%, the present value of that future cash flow is actually getting lower and lower year by year because of that opportunity cost. It's very interesting. And that's why Buffett in that clip said the further out in time you go, the less consequential it is to your intrinsic value. But anyway, so we've discounted the 10 years of future cash flows, 15% per year. And then don't forget, we also discount the terminal value at the 10th year as well. So what we've just done is we've calculated what we'd pay today for the annual future cash flows we'll get from owning the business, and we've figured out what the big one-time check is worth to us today from selling the business in 10 years' time. Now simply add all the discounted future cash flows together, and that's the intrinsic value of the business today. If it grows its cash flows at 10% per year, you can sell the business in 10 years at 25.5 times free cash flow, and you want to achieve 15% returns per year, 595.97 billion in this instance. There you go, we did it. That is the sum of the discounted future cash flows. That is the discounted cash flow model. It makes sense, right? Then if the market cap is below the intrinsic value, then it suggests we could buy the business at its current stock market value, and we'd likely make 15% returns per year. However, there is one more step. After this point, we have to add a margin of safety to our intrinsic value, because all the stuff we've just done is technically trying to predict the future, and you can't predict the future with 100% accuracy. You just can't. So we're going to be wrong, at least in part. And because of this, we add a margin of safety to our intrinsic value, maybe 20%, maybe 30%, maybe 50%. That bit's up to you. But if you can snag the business not at intrinsic value, but substantially below intrinsic value, then that really de-risks your investment. It protects you if the future doesn't quite turn out as we predicted. However, also by doing this, if you're actually pretty correct in your future estimates, then the margin of safety will also help you achieve a higher rate of return than your calculated 15% per year. So overall, margin of safety really is a key concept. But that's it, guys. That is how Warren Buffett.
So margin of safety is, I think we talked about it some time ago. Margin of safety is a great idea, came from um, Roman history. It's an idea from engineering field. So when the Roman Empire wants to build roads, bridges, he announced a contract, or the people who wants to build the bridge, business or contractors who wants to build the bridge, and uh, initially the bridge used to collapse quite fast. I mean, it was not quality enough, and the bridges were collapsing or damaging or not being useful after 1 or 2 years. So what did the Roman Emperor did was he told the contractors or the bridge builders they have to live under the bridge for at least some months before they get their payment. So if you have been put into a situation, so it's also called skin in the game, right? If you put into a situation that you would be taking the impact of whatever that you have built, in this case the bridge builder who is building the bridge or road builder who is building the roads, then he wants to build it for the better quality as well as the better high capacity. Let's say on that bridge on given day there are 100 horse carts and 1,000 people that crosses, then the margin of safety he wants to do is 3 times. Instead of 100 carts, he will probably think of 300 horse carts and 3,000 people would the bridge will still sustain. That's the margin of safety. So he is putting 3 times of the load at time of building the bridge so that it doesn't collapse and he will die, right? Because he will be living under the bridge. So it's the same idea for investing here. In the sixth step, when he says margin of safety, he is basically saying that we want to find the intrinsic value of the business, and we also want to add margin of safety. Let's say we found out intrinsic value of the business is $100 per share. Okay, and margin of safety I want to do add is 30%. So that means even though I know the business is worth at $100, but I want to buy it when it is $70. What does it mean? I'm taking 30% margin of safety out of that $100. So I'll buy the share or the business only when it is $70. Even though my intrinsic value of the business says $100, I'm keeping 30% margin of safety. So that's how, because we are assuming quite a lot of data here, right? We are assuming uh, um, um, growth of the future cash flow. Second step, we are assuming some growth, but that growth we don't know whether we would get it or not, right? Even if we take the conservative bet, we don't know how future would be. We don't know what happens tomorrow. How would we know next 5-10 years, right? So uh, in order to protect ourselves from those uh, guesstimates or the numbers we used for calculating intrinsic value, we are using step number 6 called margin of safety, so that we want to even buy at the discount value of the intrinsic value. Okay, does this make sense? Should we do this for one of the business and find out what is the intrinsic value? So let's do that. So you can use Excel. So let's use Excel or Google Sheets. So let's do that. So I can go to ticker. Okay, so which one you want to do the intrinsic value, Google or Apple? Let's do for Google. Okay, so I will say Google intrinsic value. So okay, so look at the steps he described. So let's go back to the so
Have to add a margin of safety.
so first step we need to find the future cash flow, current cash flows. So let's go to ticker Google. So now we go to financials and then go to cash flow statements. So let's say what okay, this is 2022 so and so. So let's look at 2022 cash flow is 60 billion, 21 67 billion, 20 42 billion. So overall, if you see the growth, of course, last year it was reduced by negative 10%, but okay. So let's take it. So this is the free cash flow. This is step one, right? So this is the free cash flow, and then we need to add 2022. So I want to add up to 10 years. Okay. So this is year one, year two, 10 years. Okay. So in year 2022, the free cash flow for Google was 60 billion. Okay. So let's assume these are all billion, all numbers in billion. Okay. This is 60 billion. So the Google free cash flow growth is been more than 35%. If you see 19 to 20, sorry, 18 to 19, they grown at 35%. 19 to 20, they have been growing at 38%. 20 to 21, they have been growing at 56%. But 21 to 22, they degrow, I mean, minus 10%. So let's assume they grow at, let's say, 15%. Okay. So how do you do this? So you multiply this 60 billion, multiply, I'm looking for multiplication symbol. Okay, my keyboard is okay. So let me get that. Okay, just so what I'm trying to do is I'm trying to calculate the intrinsic value of Google by looking at their numbers. Just a second, I'm trying to change. So I increased, I added 15%. So I am expecting free cash flow in 2023 is 69 billion. Where did I got the 69 billion from? I just, you know, I assumed it will be 15% growth. So 60 billion, 15% is 9 billion. So it would be 69 billion. So similarly, if I project the same to the other years, so it will be 2024, it will be 79 billion, 91 billion, 104 billion, 120 billion, 138 billion, 159, 138 to 11 billion. So that's the free cash flow number I'm expecting with a 15% growth for the next 10 years for Google. So let's look at so we done the second step. So grow the current free cash flow out 10 years in the future. So we grown it um, uh, 10%. So next we need to add terminal value. So this is the terminal value. So terminal value is basically when we want to sell this business. Let's assume we want to sell this after 10 years. Okay, so that's when, and terminal value can be calculated based on the current multiple what it is selling for. So if I go to ticker, let's look at valuation section. You would know valuation. Currently it is selling for, where is the free cash flow multiple? Yeah, you see market cap to free cash flow, it is selling for 18.50 multiple. So it's selling for 18 times of free cash flow as on 2023 March. 2022 it was selling for 15.69. 2022 it was selling for 16.47 multiple. So average, let's assume we managed to sell it for 15 times multiple. So what would be 15 times of free cash flow, right? So we just take the free cash flow, free cash flow in 2020, last free cash flow 2031 is 211 billion. So I multiply that with 15 times. So this is the value I want to sell my business at the at, at the end of the I mean the terminal value. So I am able to, I hope I am able to sell it for $3.1 trillion, because it's, how would I got the 3.1 trillion? I just took the free cash flow generated from 2031, that's 211 billion, and multiply with 15 billion. How did I determine 15 number, 15 multiple? It's basically based on the history. So currently Google is selling 18 times of free cash flow, 18.5 times of free cash flow, and last year it was selling for 15 times free cash flow. So on average, I assumed I am able to sell this business after 10 years of holding it for 15 times of previous year cash flow. So that's 211 times 15, that would be $3.1 trillion. Okay, does this make sense, or is it too much? Do you have any questions? Are you able to follow this uh, thinking?
And most of it.
Okay, so so now what we did here, step one, we looked at the free cash flow. We got the free cash flow for 2022, and we projected it will grow 15% every year. So we projected it for 10 years. So That's it's a simple formula, right? We just took the last year free cash flow multiplied with 1.13, that's 15%, and then you get the mm, free cash flow of that given year. And then we need to find the terminal value when we want to sell the business. What is the multiple we can sell it for? So we assumed it would be 15 times of the free cash flow of the previous year, that is 2031. So if you do 15 times of 211, it would be $3 trillion, $3.16 trillion. So now we finished, um, we also finished the step 3. Now we need to discount the cash flows to present values, step 4. So let's discount that step 4. So now if you want to discount it back, just a second, I'm just looking at. So we need to, so divided by, I'm looking for to the power of this keyboard is not working for me. Okay. Did you started calculating? Are you using Excel at school?
Not so much.
Okay.
We don't have ICT that much in school.
Yeah, in ICT we're doing it like once a week.
So basically, okay, let me bring, I'll show you the formula, then you understand what I'm trying to do here. So I'm discounting this free cash flow, 60 billion to the present value. Um, so, so I'm just using the same formula like he did. So he basically discounted the whole so that's the discounted value. So you see the difference, the actual value is 69, but we're discounting that back to present value at 15%. So that would be, no, it's not, just a second. I need to do it for, No, something wrong here. Let me calculate this again and I'll show you. But basically what we are trying to do here is we are trying to get the free cash flow and then trying to get the discounted back the future value to the present value to find the intrinsic value. So let me do this calculation and I'll show you next week how to use these formulas. I thought it could be easy. Okay, so so once we know the yeah, I think here in the video you can see once we know the um, intrinsic value, it's a sum of the future cash flows discounted back to the present value, then you know the value of the business, and then I can show you what would be the intrinsic value of some businesses and comparing with that with the current prices, and then you can say is it in undervalued or overvalued. So this is one of the method used for finding the intrinsic value. There are other methods that people uses to find the intrinsic value, but this is most well-known method. Many people recommend using it because it eliminate a lot of noise and it brings you the real value of the business. So this is one even recommended by Warren and many other investors. Okay, so one fun exercise I would recommend you to do. Uh, So I think I shared this site last time. It's called Data Roma, and here you will find all the great investors where they are investing uh, in businesses. So, for example, if you see here, you have a super investors portfolio, and they investing on this 10 businesses. And let's look at yeah, I think. Let's look at Warren Buffett. So this is Warren Buffett. So Berkshire Hathaway, Warren Buffett, and then you see all the businesses he invested. So let's say he added this business last quarter, and so fun exercise that you can do is what valuation these guys bought the business, like based on the what was the intrinsic value they were been paying to buy those businesses. For example, um, so Lilu, he was buying Google until December last year. So you know the what was the share value Google was selling for last year end, and then you can see how much value based on your calculations. I think if this formula would have worked, if we would have known what would be the intrinsic value, then look at the great investors and see what value they paid when they bought these businesses. So that way it will be a good exercise for you to understand what valuations they are paying for a business, how you know they are mm, mm, finding the value in those businesses, looking at the purchase time and then the current value. Okay. So here you can find quite a lot of investors, and then you can see what prices they are buying, what businesses they buying, and then you do the inversion, right? You basically see why would this guy bought this business, and then look back and deep dive into the business to understand how you can think through is a lens to understand why. It's also called cloning. That's also one way. You don't need to be a smartest in the room. You just look at what other people are buying and then the reverse engineering the idea and find out what value that they see in the business, and does that make sense for you. Then if it makes sense for you, you could also go and buy businesses, invest in those businesses. That's one trick. We can use it from psychology, cloning, reverse engineering. So you just clone the other's idea and then you reverse engineer it, how they have thought through it, and does that make sense. Then you can go and buy it also based on that. Okay, any further questions? Yeah, Parthiv.
But wouldn't inflation also make the money that they would have earned less?
Yes, you are right. So I think the question is related to the free cash flow, right? The money
Yeah.
the businesses generated, would we also add the inflation into the equation to see how much they are worth, right? Yes, it would definitely play a role. And this 15% return we are expecting, it's inflation adjusted. So let's also look at that the how the inflation would play into these numbers when we are calculating
So,
that.
so the numbers you're telling is today's worth of money, not that time's worth.
Yeah, exactly. That's correct.
Okay.
That's what we are doing when we are doing the discounting back to the present value. Yes. And then we add up. Yeah.
Yes.
The concept you are learning is most advanced concept, this discounted cash flow. This is one whole subject when you go to MBA program. But yeah, I'm trying to simplify it for us to look at the businesses and calculate the intrinsic value. So maybe I can give you some idea where we are heading now. So we looked at the business models of the businesses to understand how you can analyze model the business. You remember that business model canvas we talked a few sessions ago. Then we looked at the numbers, how to analyze the numbers. Now after we looked at the numbers, now we are calculating the intrinsic value of the business. So basically next future sessions what we can do is we can pick up any business, look at their free cash flow, calculate the intrinsic value based on the discounted free cash flow model, and then say that hey, it's overvalued or it's undervalued, and etc. And we don't need to pick up any other businesses. We can just pick up the businesses that the most famous investors are investing in. That way it gives us the idea, okay, if these guys are investing, they must be smart and they've been in business for many years. Let me pick up those businesses and try to calculate the intrinsic value. That way it will be a good exercise for you to how to look at businesses and find the intrinsic value of the businesses, and then based on that you can make a decision whether to buy business or or whether you wait for a further correction. If it is overvalue, what should you do? You just say that you wait. Let's assume you are a cricketer, you get a tough ball. What you'll do, you pass on the ball because it's a tough ball, you can't play it, you pass on it, right? But in investing world, but in cricket world, you have limited overs time, so you have to attack the ball no matter how tough or how difficult, how easy it is coming. You have to hit it. But in investing world, it's not like that. Even you get 1,000 tough balls, you can just stand there not doing anything. That's coming back to the psychology and human behavior, right? So that's the advantage of this game. You don't need to hit all the balls. You just wait until you get the right ball, then you hit the six. So you wait until the businesses comes under value, under the margin of safety number, whatever the margin of safety you want it, and then you hit the six or you buy shares, right? So that's the beauty of this game, that you are not biased, or you don't need to hit all the balls, or you don't need to play every ball. You just wait until the prices are at your comfortable valuations based on your intrinsic value calculations. Okay, any other question? That was a good question, but okay, with that, let me conclude here. Let's do the discounted cash flow again next week. I'll try to get the formulas right this time, and then we'll do at least 3-4 businesses just to get the idea. Okay. Thank you, and I wish you a good Sunday.
Thank you. Bye.
Thank you. Bye.